All right, so, sometimes people sit there and they're just kinda go, okay, so is the lender coming up just to kinda give a pitch? Well, like, no. Yes, but the bottom line on this is that there's a little bit of an art form to this. And I'll just give you an example. I had a situation where, I think it was in November, that Jax had called me, and it was really interesting, because I went back and I looked at, after I got the guy's name and everything else, and I put it into my, and I put it in my phone and everything else. Then I got an email from him, and like how if you have a Gmail account, like when you start typing somebody's email, it'll just pop up if you've had it. I'm going, when have I sent this guy an email before? And I had sent him one back in 2016, when he was first looking at buying a second home up in Cedar Hills. And anyway, long story short, I mean, he put down like $100,000 on a $700,000 property. And at the time, he's an attorney, and he's self-employed, and he just said, my tax returns are just so complicated, I just don't wanna deal with having to give all that stuff to somebody, so that's why I'm doing seller financing. I go, well, great, well, you're working with a great agent, you're gonna work with a great title company, and, the guy had good credit and everything else, and so I basically just, talked with the seller and said, yeah, he's good. He says, well, what does he make? And I said, don't know. And I said, what do you care? He's putting down $100,000, and it's a contract for deed, right? So, anyway, long story short, rewind it 3 years forward, and his wife's friend's brother-in-law, whatever, and they had been spending 3 months trying to refinance his contract for deed. And they had got it to the point to where it was literally right at the closing, and they said, this is illegal, I don't know how you bought it. Now they're telling an attorney this, right? So it's always fun, I think, when underwriters and other people try telling attorneys what's not. But anyway, long story short, Jack says, well, remember the guy that I first told you to talk to? He says, go ahead and talk to him. Well, he had already paid the loan down by an extra $100,000 in the course of the previous 2 years, because he was just knocking down the debt. And anyway, closed the loan in 3 weeks, and he was just like, why can you do this when somebody else who's at a big mortgage company and, says that they've done this and everything else, how could you do it? And they didn't do it. And I said, because my underwriters have seen it before. I mean, that's it. That's really all it is. I mean, I remember the old, Life cereal commercials with Mikey. Okay, Life cereal doesn't taste bad, but nobody wanted to be the first one to taste it, just in case it did taste bad. Because when an underwriter underwrites a loan, if it can't get sold to Fannie Mae and Freddie Mac, guess who eats it? The bank. Okay, and so the money that they would make, the little bit of money that, maybe 1% that's made off of a $300,000 loan, doesn't offset the risk of Fannie Mae saying, we're not gonna purchase that loan. Your $300,000 is what you just used to buy that money. And that's not how the mortgage business works. It's money in, money out. So again, if an underwriter's not familiar with it, and there's a lot of good underwriters out there that have a lot of experience, but if they haven't actually seen these transactions get insured by FHA, guaranteed by VA, purchased by Fannie Mae and Freddie Mac, they just don't have an appetite for it. They just kind of go, there's a chance this thing could come back on me. And if an underwriter gets a lot of loans that come back on them, guess what happens to their job title? They're not underwriters anymore, because they cost the lender that they're working for too much money. I mean, imagine if they had 5 or 6 $300,000 loans that don't get purchased. That underwriter lost their job, and that does happen in the real world. So anyway, where's the pointer, Dave?
Did I? Oh. I took it with me.
Okay.
Sorry.
Okay. So, all right. So anyway, so the purpose of having a lender in there, and Dave talked about this, you need to be able to know what are a realistic time frame for the contract, because you don't want to have you don't want your buyer coming in, putting $20,000, $30,000 or more down on a contract and expecting that they can qualify in 2 years when, guess what, they don't. And even if they need 2 years to qualify, should you give them 2 years and 1 month, or would it be better to give them 3 years? That's Andrew, right? I mean, what do you think? Do you just, so that if they know that they need 2 years, you give them 2 years and 1 month? What happens if they stub their toe and are right in the middle of a job change, or they have a collection account because they didn't bring back a library book? Did you guys know that libraries, I've seen collection accounts from libraries on credit reports. Libraries will now turn you to collection for not returning a book. Well, if somebody's in this real precarious situation where they've had a Chapter 7 bankruptcy and their credit is being you know, looked at under a microscope, okay, they can't feel, they're not gonna feel comfortable putting down a large amount of money, knowing that one slip up and that money's at risk. So Dave and Jax will tell you that normally if they need a year or two, give them 5. Give them 5. And if you wanna have an incentive for them to get out of it, well then put something in there to where the interest rate might adjust. Okay, we're gonna give you 2 years because you need 2, but after the second year, the interest rate's gonna go up the third year. Then it's gonna go up again the fourth. And you know what, the seller probably doesn't have a problem with that, right, Don, if it's looking at a retirement opportunity?
But sometimes, if you can't get that long of a time, the stepping makes a seller want to go a little longer, cause you are stepping it up. The other thing you do, if they won't go the longer time, you can keep it to the shorter time frame, but then put an option in there for a 12-month extension for an additional, principal reduction, or something to that effect.
Yeah, a little more skin in the game,
Yeah, they get more skin in the game, it
There's
gives
all
12
kinds.
months, and if they needed another one, they have to put more down, or you could do that plus the interest rate. It's ways to make it, better for the seller to make them want to go a little longer if their buyer needs
Absolutely,
it.
and the beauty of it is that you're not dealing with the bank, the seller's the bank. So you can structure that, and they can say, well, hey, I'll put down another $10,000, but would you allow my loan to re-amortize? I'll pay a higher interest rate and I'll make a principal reduction, but could we re-amortize the loan? Well, on a contract, yeah, you can do that, piece of cake. So their payment might actually stay the same, but the seller just got 10 grand and they're still getting the same payment. You know, so there's a lot of great opportunities, but there's 3 things that every seller on a seller finance transaction wants to know. And it's, what's the problem? Can it be fixed? And how long is it gonna take? And should you as a real estate agent be the one to make the call? I mean, do you wanna be able to tell somebody, oh yeah, no, I know the underwriting guidelines, and if you tell me that Credit Karma says you're at 630, well, you know what, then you're probably good in a year. You know, I mean, cause everybody's kinda got their own feel of where their credit is nowadays and stuff like that. So, again, you don't wanna make the call on that, because who's gonna be liable if the deal goes bad? If you were representing the buyer, and if they lost $30,000 and you were the one making the call on the time frame they needed, they're gonna come after you, okay? The other thing is do you really wanna have in your office their tax returns, their bank statements, their pay stubs, and if you're gonna get a credit report, I mean, do you guys want that stuff transferring back and forth between buyer and seller in your office and their office?
Typically, we don't even want it.
Yeah.
At all. So-
Right, because it's gonna expose you guys to some liability. So the benefit of having a lender that can work with you on the transaction is that it's gonna reduce your liability, because you're not being an expert on every aspect of the transaction. Be an expert on where you're an expert, and let somebody else come in and put in their 2 bits on where they need to. But what I found out in working with a lot of these transactions, the best part about this is who has the motivation to make sure that the buyer follows through. Like if they haven't filed tax returns for a couple of years, if their credit's a little banged up, if they started a new business and they've gotta file tax returns. Okay, at the transaction, if the buyer's bringing in 10% down, is there enough money there from the buyer to pay the buyer agent commission? Yeah, how about the seller agent commission? 10% down from the buyer, right? There's plenty to pay 6% real estate commissions, enough to pay closing costs, the title costs are very nominal, and the seller is also gonna walk away with some money too. So who's involved in this transaction and didn't get paid? The lender, right? So I have some incentive to work with that buyer, whether it's a year or 2 years, to make sure that they can complete their financing if the seller is expecting to get cashed out. So, you know, it doesn't cost you anything to work with me, it doesn't cost the buyer anything to work with me, and, you know, frankly, I've got a file folder, you know, just of all people that are at various stages on stuff, and Dave and I closed a transaction in December that we started over 2 years ago, but that's how long they needed, that's how long he needed, and it worked out, and it was a great deal. Dave got a great return on his money that went in there. The buyer has a much better loan now than what he had started out with when he was in trouble. And, you know, and it was great. And I've got a client, we get referrals from these people, they love us. So, anyway, so those are some of the benefits that you do there, but also how to reduce your liability. And then, we've talked about this a little bit, but there's really no problem that doesn't have a solution to it. there's nothing in the underwriting guidelines that says that if somebody has a foreclosure and a bankruptcy, that your time frame for getting into a house is never. Does it say that? Does it say that? Oh, if you have tax liens exceeding $100,000, you can never buy a home. Okay, so there's nothing in the guidelines that says that this type of a credit situation equals can never own a house. There's always a time frame. It's just a matter of identifying, well, what are the issues on this and what is the time frame? So, nothing that we worry about. And then really all I wanna do is just hammer home here is that we talk about having a lender that works with your people as a coach instead of a referee. I mean, I get a lot of people that they get discouraged with the process because like they kinda get interested in buying and they're timid. They don't like the idea of having to disclose all the stuff that they think that's gonna have to be disclosed, and oh my gosh, I don't want them looking at my bank statement and seeing how often I go to, Starbucks and Taco Bell. And nobody cares, But some people get this fear, and so what do? They just kinda go, well, I've been banking at my credit union or at my bank for all this time. And they go in there and they sit down and they take a loan application with somebody who was opening somebody's checking account 30 minutes earlier, and now they're just filling in the blanks on a loan, and they dump it into a loan application, and they click a button, and it goes through automated underwriting, and the automated underwriting says no, and they go, huh. And then they're just, the referee, they pull the flag, and they go, well, automated underwriting says your credit score is not good enough, or you haven't been on your job long enough, or your debt ratios are too. But anyway, they don't really work with them beyond that because they don't know how to. And so you want somebody that, I personally believe that probably half of the people right now that want to buy a house and can afford a house payment, for a variety of reasons, probably right at this moment, don't qualify. But do they not qualify ever? No, most of them probably qualify in 30 days, 90 days, or 6 months. And it's a matter of saying, okay, well great, well what's the problem, how do we fix it, and how long is it gonna take? And it's just a matter of just coaching people and giving them a game plan. And a lot of times, I see real estate agents will do that with sellers that if they're not ready to list like right this minute, but they may be working through a few issues. I mean, I get it with the immediacy of, wanting to try to call to action and close a deal. But there might be some reasons why sellers can't list their home right now. And so if we can kind of have a coach's mentality instead of a referee's mentality, we're gonna get a lot more people. And the thing that I love about working with the people that maybe are not ready for prime time, but eventually come that way, they're awesome referral sources. I mean, they're much more loyal than somebody who has $100,000 to put down, an 800 credit score, and a low six-figure income. I mean, those people look at you as a commodity of like, well, look, I can buy any house I want. What kind of a deal can you get me, and how are you gonna reduce your commissions, or how are we gonna work a deal to make this work for me? And the same thing with me. It's like, well, George, I looked at the internet, and they're paying me 1% interest to take out a mortgage on the internet, and they're paying me closing costs. I mean, can you match that? Well, no. I mean, those people, and that's fine. There's a place, and I'm always happy to work with people like that. But they really don't need an expert. They can go out there, and it's just they need to go and fill up, and Costco happens to be cheaper and more convenient that day, so that's where they went. So anyway, there's a lot of people that need some help. But anyway, there's all kinds of opportunities out there that we don't know exist, and Dave is an expert at finding those deals, and I think Don has a few agents in his office that are doing pretty well with it as well, right? So anyway, the seller financing stuff that we're talking about here, Dave has kind of talked about this, I don't want to get into it too much, but I have an FHA underwriting manual from 1986. I started in the business in 1989. And in 1986, the underwriting manual, which was like this little pocket, little cool thing that I had, it references contract for deed and land contracts and other similar financing arrangements where the buyer does not have title to the property. The language hasn't changed. The only thing that's changed from 1986 to today is that if you're gonna refinance a contract for deed, there has to be, the notice of interest or the notice of contract has to be recorded against the property. So in 34 years, that's the only thing that has changed in the underwriting guidelines. So this is not something that's new. This is something where we're just sitting there going, well, wait a minute. This was being done way back when interest rates were in the teens, is there any relevance to it now? And it's like, well, the answer is yes, there is. But not too many people do it, and I think a lot of agents pass up a lot of business because they don't know the things that you can learn here, so. Anyway, so, it's all the guidelines are referenced in here. Timeframes for refinancing, it can be as little as immediate or as long as 12 months. And the answer to that question is, it depends. So that's where it comes in, just understanding the underwriting guidelines. And then the other thing is on here is that, can the seller sell their house and buy another house? Well, this is one of the things where the underwriting guidelines have loosened up a little bit. 10 years ago, we had all these buy and bail rules that had come in, and it was very difficult. If a seller really intended on renting out his house and putting down some money and going and buying another house, it was pretty tough. The home that they were selling had to be at 75% loan to value. And if they had a tenant in there, they had to have, a deposit, and first month's rent deposit. It had to be a 12-month lease, and then they had to qualify for both payments, even with a lease agreement. So that's really relaxed quite a bit. So it's much easier now to get a buyer using his current subject property as what we call in the underwriting guidelines as a proposed rental. So proposed rental properties, in other words, you're proposing to rent your home and get into another one, that's quite a bit easier now.
Why are you classifying it as a rental and not a sale?
Because the home's not listed and they're not gonna sell it. In other words, they're probably going to sell it,
Right.
okay, but we maybe don't need to right now. Maybe they've got enough money to get in there and they just wanna be able to get into the new house and close on that, because you see a lot of times where people, they're not quite ready to sell the home, and I've had this happen several times where they're like, we really weren't looking for a house, but this one came up. Now we wanna buy, and we don't have, and our home's not ready to sell yet.
So maybe you covered this earlier, and I apologize for coming in late, but so are we considering the contract for deed as, from an underwriter's perspective, as a lease agreement?
Most of the time, yes.
Okay.
Okay.
Okay, alright, that makes sense.
Is that a good non-answer? Just wait till Jax gets here. You wanna hear some good non-answers, wait till the attorney's in front of the
Okay.
class. Yeah, so that's, so anyway. But anyway, so can we show the income? Yes. Can the seller buy another home immediately? Yeah, most of the time. And then, if not, we'll explain how long. But the cool thing is here is, can I make money on the bank's money? And Dave talked about this a little bit, and this is the really cool thing about this. I mean, where else can you go out and borrow $250,000 one day and the very next day lend it back out to somebody at your interest rate plus 2% or plus 2.5%? And yet, that's the kind of opportunities that this creates. And, I mean, let's face it, I mean, are banks lending out their money? No, okay? They're borrowing at a lower interest rate, lending it out at a higher interest rate, and we just accept that. And we just kind of go, whoa, well, yeah, well, they're a bank. I mean, that's what they do. Well, how cool is it when you can teach a seller how to become a bank? And there's a lot of benefits to that. I mean, tax considerations, and I mean, how the income is taxed at a lower rate instead of as ordinary income. So a lot of cool things, and Dave gets into a lot more of this when he teaches some advanced classes, and he just finished teaching one at my office. It was last Wednesday, but anyway, so he'll let you know when he does some more, but there's a lot more, that 90% that's below the water line. There's a lot more stuff there that's discussed, and Dave and Jax both will get into a lot more details on that.
But the income from the seller, when they have their rent or proposed rent, do they count 100%, or are they gonna count 75% against their debt to income ratio?
75.
75. Yeah. But the way that it's treated though is much different than if, so because in other words, let's say they're gonna get $2,000 a month in proposed rent, and they've got a $1,500 a month house payment. Well, 75% of that $2,000 is $1,500. So it's a wash.
Just
I mean, from
negates
an
the
underwriting
payment.
standpoint. Yeah,
Do
just
they
wipes
need
it.
to have a rental contract or a contract for deed or something to that form, or can they get it just showing that that's the market rates, or do they need to actually have a contract?
Need to have preferably a rental agreement. Have a lease agreement and have it for 12 months.
If they
Either
don't,
lease agreement, rent agreement, or contract for deed, any of those.
Dave, I'm gonna have Dave come back up. So anyway, so